Welcome to the next video in my most complete video series that you'll find on YouTube regarding buying a home. This is video 7. In the last video, we discussed negotiating repairs based off of your inspections. We went over the different type of negotiation options that you can have and why you would want to have them done. In this video, we're going to go over the appraisal process, the title insurance process, the homeowner's insurance, and flood insurance. This is your opportunity to ensure that the home that you're buying is actually worth what you're paying and that it is protected from all aspects. I'm David Karras, and in this video, I'm walking you through different steps that you need to take during your due diligence period. Now, most buyers rush through this phase or they skip critical steps to try and save some money. Then they move in and something happens and it ends up costing a lot of money. Don't let that be you. Now, by the end of this video, I want you to know that exactly what an appraisal is and how title insurance works and how other insurance aspects of home ownership work. Well, first, let's get into discussing the appraisal process. The appraisal process is the most critical step in the home buying process. It literally determines whether your lender will approve or deny the loan. Now, what is an appraisal and why is it required? Fantastic question. An appraisal is an unbiased professional opinion of the home's market value. It's conducted by a licensed appraiser. Now, why will your lender require an appraisal? Well, it's pretty simple. The home, it's collateral for the loan. The lender needs to know that if you default on your loan, that they have the value in the home that they can sell it and recoup their money. Now, lenders will only loan based off of the lower of two things, the purchase price or the appraised price. Okay, let me give you an example here so that you can kind of understand. Let's say you agree to buy a house for $400,000. You're going to put 20% down. That means the loan amount is going to be $320,000. If the appraisal comes in at $400,000, no problem. The loan amount is $320,000. What happens if the appraisal comes in at $380,000? Problem. The lender will only give you $304,000, which is 80% of $380,000. So now you need to kind of, where am I going to get $16,000 from, right? Or you have to renegotiate the price of the contract. Now, who orders and who pays for the appraisal? Your lender will order the appraisal. There's a phone number they call to order it. You can't choose the appraiser, and you pay for it. $400 to $800 depending on the home size and location. An appraiser, it's independent. They can't be influenced by buyer, seller, or the agents. So when does it happen? Well, usually about a week or two into the contract. It takes about 7 to 10 days to receive the appraisal report and one of the longer lead time items in the process. So what if you're paying cash? Well, your lender won't require an appraisal because no lender, no requirement. But you should still get one for your protection. You don't want to overpay. It costs $400 to $800. Don't be cheap when it can save you $20,000. Now, what appraisers look for? Appraisers evaluate the home and compare it to recent comparable sales, similar to CMA that your agent prepares. Now, what an appraiser examines? They look at the property itself. They're looking at square footage. They're doing measurements and verifying them. They look at the number of bedrooms, the number of bathrooms, the age and condition of the house, the quality of the construction. They're looking for updates and renovations. They're looking at layout and functionality. They're looking at the lot size, garage size, and if there's any outbuildings. Let's talk about condition. Overall maintenance and upkeep. Major systems like the HVAC, roof, plumbing, electrical, and any obvious defects or damage. Location. They're looking at the neighborhood proximity to amenities such as schools, shopping, street traffic views, things like that. Comparable sales. The appraiser pulls recent sales, typically the last 6 months. They look for homes that are truly comparable. Same neighborhood or comparable, very close. They're looking for similar size, age, style, and condition. They're looking for similar lot size. You can't compare a house on 10 acres to a house on 1 acre. They make adjustments for differences. Let's say a comparable home is larger. They're going to adjust the value down. If a comparable home is in worse condition, they'll adjust the value up. If a comparable home has a pool and the subject property doesn't, they'll adjust the value down. Now, once they have this data, they calculate a final opinion of value based on the adjusted comparables using the sales comparison approach, which is the most common for residential properties. Now, what is the appraisal report? Fantastic question. It is a detailed report, including photos of the home exterior and interior. There's a description of the property, the comparable sales used, and adjustments made to determine the final opinion of value are on this multi-page form. You'll receive a copy of the report. The seller does not, just the lender and the buyer. So what happens if the appraisal comes in low? This is one of the most stressful situations in home purchasing, and here's how to handle it. Why appraisals come in low? Well, if you overpaid, right, you offer too much in a competitive situation, right? You might be at low if the recent comparable sales don't support the price. It might come in low if the market has softened since you went under contract. Might come in low if the appraiser used poor, outdated comparables or made an error. So what a low appraisal means is that the agreed upon price is higher than the actual value. And because of this, you will have to renegotiate the price or terminate the contract if the seller is unwilling to lower the price and you do not have the cash to bridge that gap. This is why it is imperative to ensure that you protect yourself in your offer using the right forms to ensure that you can renegotiate or terminate due to a low appraisal. Typically, sellers will agree to drop the price if the market supports the lower value. They might do it if they're motivated to sell or if they realize they were asking too much, or if they don't want to start over with another buyer who will have the same appraisal issues. And because that appraisal sticks with the property for a specific period of time for that loan type, which will cause them further issues in the future. Now, another option is you can get a second appraisal. With some loan types, you can pay for a second one. If it comes in higher, you can use that one. If it comes in the same or lower, you just wasted some money. And not all lenders or loan types will allow this. So the bottom line on low appraisals is this. Don't panic. Review the appraisal carefully. Work with your agent to negotiate and consider all aspects. Don't agree to pay significantly more than appraised value unless you're confident it's worth it and plan on staying there long term. Now, your appraisal contingency protects you. You need to use it. Next, we're going to go and start talking about title search and title insurance. Wow, it's not very sexy, but it is something that is very important in the home buying process. Title insurance protects you from legal issues with the property's ownership. It's one of the most important and least understood parts of buying a home. So I'm going to try and clarify some of it without getting down into the weeds. So let's talk about what is title insurance and why it's important. Title insurance protects you from financial loss if there are defects in the title, such as ownership of the property. So what does clear title mean? Clear title means the seller legally owns the property. No one else has claim to the property. There are no liens, no judgments, no encumbrances that would prevent transfer. The seller has the right to sell the property to you. Well, how do we figure all this stuff out? Well, we do a title search. Before closing, a title company, or in some states an attorney, will conduct a title search. They're going to review public records going back many of years. Usually go back to the original buyer. Okay, they search for liens. Those are debts that are attached to the property. They're going to look for judgments against the previous owner. They're going to look for unpaid property taxes, unpaid HOA dues. They're going to be looking for easement and restrictions issues. They're going to be looking for errors in public records. They're going to look for forgery or fraud in past transactions. They're going to try and see if they can find any unknown errors claiming ownership. They're going to look for mistakes in legal descriptions, or if there are issues that are found, they must be resolved before closing, or you'll be buying someone else's problems. Nobody wants that. So what is title insurance? Title insurance is a policy that protects you if title issues arise after you purchase the property. There are two types of title insurances. You got the lender's title insurance policy, which will be required by your lender. It is designed to protect the lender's financial interest in the property. It is required by your lender, and the coverage equals the amount of your loan, and it protects the lender, not you. Owner's title policy, optional but highly, highly, highly recommended. It protects your financial interest. Coverage amount equals purchase price. It protects you from financial loss if title defects are discovered after closing. Let's talk about the owner's title insurance. All right, it is one-time fee paid at closing and lasts as long as you or your heirs own the property. Well, why would you need owner's title insurance? Well, title searches aren't perfect. Issues can be missed or hidden. There are unknown heirs could be claiming ownership years later. There could be forged signatures on past deeds, errors in public records, unpaid liens from previous owners. There could be fraud or impersonations in past transactions. There could be easement issues that weren't disclosed, mistakes in surveys or legal descriptions. Without owner's title insurance, you'd have to pay legal fees and potentially lose your home or pay off someone else's debt. With owner's title insurance, the insurance company defends you in court. They'll pay the legal fees. The insurance company pays claims up to the policy amount. Cost of owner's title policy? Well, great question. It's one-time fee at closing, typically somewhere between $1,000 and $3,000 depending on the purchase price and location. Some states, like here in Texas, they have regulated the rates, and where others allow it to be negotiated. So who pays for title insurance? It varies by location and custom, right? I bought some land in Delaware. In Delaware, the buyer pays for it. Here in Texas, most of the time the seller does. In some areas, it's all negotiable. Your agent will know the local customs. Is it worth it? I would go with absolutely. For a one-time fee, you protect your largest investment from hidden legal problems. The risk of not having it far outweighs the cost. Let's talk about some common title issues. Okay, here are some of the most common title problems that can delay or derail a closing. Liens on the property. Those liens could be mortgage liens. Right? The seller hasn't paid off previous mortgage, must be paid at closing from seller's proceeds. There could be an M&M lien, like their mechanic and liens, right? So if a contractor comes and they put a lien on their house for unpaid work, the seller's got to pay these off before closing. It could be a tax lien, federal, state, or local tax liens against the seller. These must be resolved before closing. The HOA, the weed Nazis, they can put a lien on your house for unpaid HOA dues or special assessments that must be paid before closing. There could be judgment liens, a court judgments against the seller for credit card debt, lawsuits, things like that. They can be attached to any property that the seller owns and must be paid or settled before closing. There could be errors in public records, clerical records or clerical errors in record documents. Could be including incorrect names, legal description, property boundaries. They got to be corrected and recorded correctly. There could be easements and restrictions, such as utility easements, a right for utility companies to access part of the property. Usually not a problem, just needs to be disclosed. There could be private easements, right? Maybe the neighbor has a right of way to cross your property. Maybe the previous owner granted access rights that may affect your use of the property. There could be HOA or deed restrictions. These limitations on what you can do with the property. Maybe you can't build certain structures. Maybe you can't paint certain colors. You need to review them carefully before closing. There could be boundary disputes. The survey shows the property lines different from what the recorded neighbor's fence has, or neighbor has. Like a fence or structure, it could encroach onto the property. That must be resolved. It often requires a surveyor and an attorney. There could be some unknown babies out there, right? The previous owner died and not all heirs signed off on the sale. The heir shows up claiming ownership. Title insurance protects you from somebody's baby. There could be fraud or forgery. Someone forged a signature on a past deed. Property was fraudulently transferred. Title insurance, they protects you from that. Let's say there are unpaid property taxes. The seller, they owe back property taxes. Those have to be paid before closing, usually from the seller's proceeds. Errors in legal description. Property boundaries or address are wrong in public records. This got to be corrected. Undisclosed spouse. Seller is married, but spouse didn't sign the deed on the previous transfer. Spouse may have ownership rights. They must be cleared up. In Texas, even if they're married and not on the paperwork, 50-50. Right? Most title issues can be resolved. The title company identifies issues during the title search. Sellers must clear the title before closing. If seller cannot clear title, you can cancel the contract and get your earnest money back. Now, your title insurance protects you from issues that weren't found during the search. The owner's title insurance versus lender's title insurance. Understanding the difference is critical because one protects you and the other one doesn't, right? As I mentioned before, lender's title insurance, it protects the lender only. So why is it required? Because it protects the lender's investment in the property, right? Coverage amount is equal to your loan amount. It decreases as you pay down your loan. It typically costs $1,000 to $2,500 depending on the price of the house and your location. And it lasts until the loan is paid off. It's usually paid for by the buyer, right? Not the lender, which kind of sucks. So what it covers, the lender's financial interest in the property. So if a title defect causes the lender to lose money, they're protected. It does not protect you personally. So here's an example. You buy a house for $400,000 with a $320,000 loan. There's an unknown heir that appears and claims ownership. Court rules in heir's favor, you lose the property. Well, lender's title insurance will pay the lender $320,000 that they lost, right? Your loss, $80,000. Your down payment, right? Plus moving costs and emotional distress. You get nothing without owner's title insurance. Owner's title insurance, well, it's there to protect you, the homeowner. And why do you need it? Because it protects your investment and your financial interest up to the coverage amount, which equals the purchase price. Okay? It just varies based off of the price, but it can usually be bundled with a lender's policy for a little bit of a discount. It is in place as long as you or your heirs own the property, even after you sell it. Who pays? Well, you do usually, unless you negotiate for the seller to pay. What does it cover? It covers your financial interest in the property, legal defense if someone challenges your ownership, financial loss if a covered claim is valid. So here's an example. Same scenario. Unknown heir appears and wins in court. Owner's title insurance pays you $400,000. That's your full investment. You've made fully whole. So why many buyers skip owner policies? It's a mistake, okay? Don't do it. Lender requires lender policy, so buyer thinks they're protected. Wrong. Buyer doesn't want to pay the extra $2,000 at closing because the buyer thinks, what are the odds something's going to go wrong? Let's talk about the reality. Title defects happen more often than you think. According to industry data, title issues affect 25% of title searches. Most are resolved before closing, but some are discovered after. And when a claim happens, it can be financially devastating. The bottom line, lender's title insurance is required and it protects the lender. Owner title insurance is optional, but strongly recommended because it protects you. Spend the extra $1,500. It's cheap insurance for your largest investment. Negotiate the seller to pay for it. Then you get it for free. Why title insurance matters? Well, title insurance is different from other types of insurance. And here's why it's critical. Okay, it's backwards insurance. Most insurance protects against future events, car accident, fire, injury. Title insurance protects you against past events, something that happened before you owned the property, something that you never even would have known about. You can't control the past. You can't know if someone 30 years ago forged a signature. You can't know if there's an unknown heir somewhere out there. You can't know if public records have errors. Title insurance gives you peace of mind. It's a one-time premium. You pay once at closing. Coverage lasts forever as long as you or your heirs own the property. Now, unlike homeowners insurance, which is an annual premium, title insurance is that one and done. Let's talk about legal defense. Legal defense is included. So if someone challenges your ownership, the title insurance company provides legal defense. They cover legal fees. The legal fees are expensive, right? They can be $300, $500 an hour. The title company is going to pay these. Without title insurance, you'd be paying that out of your own pocket. Claims are paid in full up to policy limits. If a valid claim is made and you lose, title insurance pays the policy amount. You're made financially whole and protects your equity. As you pay down your mortgage and you build your equity, your owner's policy still covers the full purchase price. Your coverage doesn't decrease, unlike the lender's policy. Now, here's a cool thing. Sometimes title policies can be transferred. If you sell the property and the buyer has a title claim related to your ownership period, your policy can still protect you. You get that peace of mind. You can sleep knowing that if a hidden title issue appears, you're protected. This is especially important for older properties with long ownership histories. Now, let's look at some real-world title insurance claims. Forged deeds. A previous owner forged his ex-wife's signature on the deed when selling. Years later, ex-wife sued for ownership. Owner's title policy paid the claim and legal defense. Then let's look at unknown heir. Property passed through an estate without all heirs being notified. Heir shows up 10 years later claiming ownership. Title insurance covered legal fees and the settlement. Let's talk about an M&M lien, right? Mechanics lien. A contractor filed a lien for unpaid work, maybe doing an HVAC or a roof. All right. The lien wasn't discovered during the title search. It appeared after closing. Title insurance pays the lien. Survey error. The survey error resulted in the home partially on a neighbor's land. Neighbor sues to force removal of the structure. Title insurance paid legal fees and settlement. These are real scenarios that happen regularly. The bottom line is this: owner's title insurance is one of the most important protections you buy when purchasing a home. Don't skip it. The one-time cost, minimal compared to the financial devastation of a title defect. Now that we went over title insurance, let's go over homeowner's insurance. I know, it's still sexy, right? But it's important. You can't close on a home without homeowner's insurance unless you're paying cash. Your lender will require it, and you need it to protect your investment. Even if you're paying cash, you should get homeowner's insurance. Homeowner's insurance protects your home and belongings from damage and protects you from liability. Standard homeowners insurance policies, or HO3 policies, is the most common policy for single-family homes. It covers the physical structure of the home, attached structures like your garage, your deck, your patio, from fire, lightning, windstorms, hail, explosions, vandalism, theft, weight of ice, snow, water damage from burst pipes. It covers a lot of stuff, but it doesn't cover flood. That requires a separate policy. It doesn't require cover earthquakes, right? There, depending on where you're at, it may exclude some other things. It doesn't include normal wear and tear. It doesn't include intentional damage. It doesn't include other structure coverages such as detached structures for your shed, your detached garage, your fence, typically 10% of the dwelling coverage, right? Personal property coverage, your belongings, such as your furniture, your clothing, your PlayStation, right? Typically, 50 to 70% of the dwelling coverage covers some perils as dwelling. Now, off-premise coverage, such as belongings stolen from your car or hotel room, right? It could cover loss of use coverage. If your home is uninhabitable due to a covered damage, it could pay for a hotel or rental cost. It can also give you additional living expenses, and it's typically 20% of the dwelling coverage. Personal liability coverage. This is a great thing about it too. It protects you if someone is injured on your property. It covers legal defense and damages if you get sued. So the standard 100, 300, recommended 300, 500, that is really for car insurance. So if you hear that, you don't want to put that into homeowners coverage. But they do have different levels of coverage in there. So if someone slips down your stairs, they can sue you. If your dog bites someone, if a tree falls on a neighbor's home, right? You can pick that dollar amount. Medical payments to others. It pays medical bills for injuries on your property regardless of fault. Those are typically $1,000 to $5,000. Sometimes it can be a little bit more. It just depends on the policy. For example, a guest trips and breaks their arm. Insurance pays medical bills without a lawsuit. What your lender requires. Well, your lender is going to require dwelling coverage that must equal the loan amount or must equal the cost to rebuild the home. It's also known as replacement cost. Typically, the lender is listed as the mortgagee. So that's also known as a loss payee. So if there's a claim, the insurance pays the lender first. You named as the insured. Your policy must be in your name. Proof of insurance before closing is required. So you have to give that proof to the lender before closing, and it'll go to the title company as well. Usually needs to be in effect on or before the closing date. You can't close without it. Let's talk about continuous coverage. If your policy lapses, the lender can place insurance. You don't want that. It's extremely expensive, and it gives you very, very basic coverage. They will probably want you to set up escrow for insurance. Many lenders are going to require that escrow account for homeowners insurance to pay. You pay into it monthly with your mortgage payment, and the lender pays the insurance premium annually from your escrow account. Your property taxes go into that as well. Now, getting quotes and comparing policies. Don't just buy the first quote you get. Shop around and compare carefully. Now, here's how you get quotes. Start early. Begin shopping 3 or 4 weeks before closing. That gives you time to compare without pressure. Get multiple quotes. A minimum 3 to 5 quotes. The more, the better. Well, where can you get your quotes? Well, you can go to independent insurance agents like Allstate, State Farm, Geico. You can work with multiple insurance companies, right? You can provide quotes, or they can provide quotes for different carriers. Okay, you can get captive agents, right? Working for one insurance company, like the State Farm, the Allstates. Or you can look for brokers. Brokers, they can shop different companies. My insurance company can shop 12 different companies. Let's talk about online comparison sites. Sites like Policy Genius, Insurity, Zebra. Get multiple quotes quickly. You can go to direct from insurance companies. The company websites often have online quote tools. Ask for recommendations. Your real estate agent, your friends and family, your mortgage broker. If you don't know what you're getting, talk to somebody and get some advice before you get the wrong coverage or too much coverage. So here, let's talk about what information you'll need to provide. They're going to need property information, right? They're going to need the address, the square footage, the roof type, the year built, the construction type. Is it frame? Is it brick? The cooling type, number of bathrooms, its garage or not? Does it have a swimming pool? Is there a hot tub? The distance to a fire hydrant? Does it have a home security system? If you're within like 400 feet of a fire hydrant, you're going to get a discount. Personal information. They're going to want your name, date of birth. They're going to want your claims history for the past 5 to 7 years. Your credit score. It affects your rates in most states. They're going to know your marital status. Coverage needs, right? Desired dwelling coverage amount, deductible preference, liability coverage amount. What to compare? Don't just compare price. You need to compare dwelling coverage amount. Does it cover full replacement cost or just market value? Market value. You buy a $5,000 TV. When you get home, it's worth $1,500, right? Do you want replacement costs or do you want actual cash value? You want $5,000. You want $12. Replacement cost pays to replace damaged items with new or better. Actual cash value pays depreciated value and gives you less coverage. It costs less, though. Always choose replacement cost coverage for dwelling and personal property, my opinion. Let's talk deductible. That's the amount that you're going to pay out of pocket before your insurance kicks in. Common deductibles, $500, $1,000, $2,500, $5,000, 1%. It just depends. Higher deductible equals lower premium. Lower deductible equals higher premium. You got to figure out where your risk is at and where you want to be at. Choose what you can afford to pay if you have a claim, right? Personal property coverage. Is 50 to 70% of the dwelling coverage enough for your belongings? Can you increase it if needed? Liability coverage. Is $100,000 enough? Consider increasing to $300,000 or $500,000. Okay, those cost very little extra to add. Additional coverages. You might want to add water backup coverage. So if the sewer or sump pump, if you have one, back up. Equipment breakdown, such as your appliances or electronics, or you got a freezer full of meat and it goes bad and everything goes bad. Service line coverage, water, sewer, electric, you name it. Identity theft coverage, you can even get that. You can even get home business coverages if you work from home. Let's talk about some discounts that are available. Multi-policy discount, right? You can bundle your home and auto. Security system discount, fire alarm, smoke detector discounts, newer home discounts, claims-free discount, paying annually versus monthly. If you live in a gated community, you can get a discount. Look at the company's reputation. Check reviews and ratings. AM Best, JD Power, Consumer Reports. Look at claim satisfaction ratings. Check with your state insurance department for complaints. Just because they're all over the TV doesn't make them good. Look at their financial strength. Choose a company with strong financial rating, A or better. You want them to be able to pay your claim. Look at future costs or premium costs, right? You want to look at annual versus monthly payment options, escrow versus paid directly, policy exclusions and limitations. What's not covered? Are there coverage limits on high value items like jewelry or art, or do you need a separate policy for them? Typical annual premiums varies widely by location, coverage, and home value. The national average, $1,200 to $2,000 a year. There are states that are high cost states like Florida, Texas, Oklahoma, Louisiana, California. Right? Some states is as low as $800 to $1,500. Here are factors that affect costs: location, right? Weather, crime, fire protection, home value, and rebuild cost. Deductible chosen, credit score, claim history, coverage amounts, discounts applied. Here's some red flags when you're shopping. If the price is too good to be true, it probably is. A very low premium often means inadequate coverage. Check what's actually covered. Okay, if the company has poor reviews, they don't, but I'm going to just, for example, if you're looking up Geico and it's got a 2 stars, stay away from it, right? Check online reviews and state insurance complaints. A cheap policy is worthless if they don't pay a claim. If the agent's pressuring you, take your time. Don't be rushed. Ask questions until you understand. Does the policy have major exclusions? Read the fine print. Know what's not covered. Ways to save money. Increase your deductible. Going from $500 to $1,000, going from 1% to 2%. That can save you 10 to 20% on your premiums, depending on the policy. You can bundle policies. If you got homeowners insurance, put your car on there. Maybe get an umbrella policy, if you can start bundling some stuff on there. If you have home security, you can install a security system, deadbolts, smoke detectors. They can save money. Here in Texas, if you have the police department come in and inspect your house and give you tips on how to make it more secure, they give you a form, you send it to your insurance company, boom, save some money. If you have a new roof, new electrical, those things can lower your premium. Maintain good credit. In most states, better credit equals low insurance rates. Stay calm. Stay claims free. Filing small claims can raise premiums. Pay for small repairs yourself if possible. Ask about all discounts. Every company offers different discounts. Ask specifically what's available. All right? Do they offer a military discount? Do they offer a first responder discount? A student discount? Things like that. Bottom line is get multiple quotes, compare multiple companies, compare coverages carefully, not just choose the lowest price. Make sure you have adequate coverage to rebuild or replace your belongings. Provide proof that to your lender before closing. I'm going to share a story at the end of this video about how important this is. Many lenders are going to require it to go into escrow. All right, you're going to pay 1/12 of an annual premium each month, and it's going to go into your escrow account. And then the lender will pay the annual premium at the end of the year out of that account. It ensures coverage doesn't lapse. At closing, you're going to prepay into the escrow. First year's premiums paid at closing, and then 2 to 4 months of escrow reserves. So what happens if you don't maintain insurance? Well, like I mentioned a little bit ago, the lender is going to force insurance on you. If your insurance lapses, the lender will buy the most expensive policy with the least amount of coverage for you. It is extremely expensive. It's 2 to 3 times the normal premium. It's minimal coverage. It covers the structure only, not your belongings. It is added to your monthly mortgage payment, so you're going to be paying one way or the other. You must maintain your own insurance to avoid this. If you have a breach of contract, right, by not maintaining insurance, it violates your contract. It violates that agreement that you have signed with the lender, and they can technically call the loan due. That means demand full repayment. This is rare, but it can happen. So tips for meeting lender requirements. So get insurance early. Start shopping in 3 to 4 weeks, like I said. Don't wait until the last minute. You want to confirm the coverage amount. Ask your lender, like, hey, Mr. or Mrs. Lender, how much dwelling coverage do you require? Make sure that your quote meets those requirements. Provide your documents properly. As soon as you have insurance, send the declaration page to your lender, send it to the title company. Don't delay. The reason why I send it to the title company, they're the ones that are going to need to know how much you're going to have to pay for your insurance and set things up. Confirm mortgage clause. Make sure the lender's name and address are correctly listed and double check before closing. You might want to just work on setting up auto pay for your mortgage. And that way you got everything taken care of, right? If you're paying directly and not escrowing it, you can set up payments automatically so you don't miss anything that way either. If you're escrowing, review your annual escrow statements and ensure that the payments are being applied correctly. The bottom line is this: lender requirements aren't optional. They're mandatory to close. Make sure your insurance meets all lender requirements before your closing date. Maintain continuous coverage to avoid expensive forced placed insurance. Now, some other types of insurance: flood, earthquake. I mean, there's all kinds of them. Standard homeowners insurances don't cover everything. Depending on your location and risk, you may need additional policies. Let's talk about flood insurance, and then we'll close. Flood insurance is insurance that's a separate policy from your homeowner's insurance that covers flooding damage. Flooding is not covered by standard homeowner's insurance. What is considered flooding? Well, rising water from outside the home, overflowing rivers, lakes, and streams, a heavy rain causing water accumulation, storm surges from hurricanes, melting snow or ice dams. And it has to usually cover 3 or more properties. It can't just be affecting your property. What's not covered? Water from burst pipes inside the home. Homeowners insurance typically covers that. It doesn't cover sewer backup. You need a separate coverage for that. Why flood insurance is important? Well, here in Texas, a few months ago, we had a lot of flooding that caused us a lot of devastation, right? Floods are the most common natural disaster in the United States. Just 1 inch of water can cause 25,000 or more in damages. FEMA estimates 20% of flood claims come from moderate to low risk areas. Homeowners insurance doesn't cover that. When flood insurance is mandatory, well, if your home is in a FEMA designated special flood hazard area, if it's in the 100-year floodplain or a high-risk flood zone, zones A, AE, AH, AO, AR, A99, B, VE. I know you don't know what those mean. Don't worry about it. Your insurance agent will. If you have a mortgage from a federally regulated or insured lender, the lender may require insurance, or they will require flood insurance if you're in those zones. So here's how you can check that out. You can talk to your insurance agent, or you can go check out the FEMA flood map system. You can go to type in a FEMA MSC map. You'll enter in your address. When you do that, you'll see your flood zone designation. It'll be colored, right? If you see blue or blue with red lines and stuff like that, then you know you're in a flood zone. Just depends on what type. So where to get flood insurance? Well, it's a national program. It's a government-backed program available through private insurance agents, backed through by FEMA. Maximum coverage is usually about $250,000 per structure, $100,000 for contents. Private flood insurance. It's offered by some insurance companies, but may offer higher coverage limits. They may be less expensive than the NFIP program in some areas as well. So you want to try and check that out. Cost of flood insurance. It varies widely based on your flood zone, right? If you're in a 500-year floodplain versus an annual floodplain, right? The elevation of the home, the age of the home, the deductible chosen. The average cost, you're looking at about $400 to $700 a year. In high-risk zones, that can go up to $2,000 or more a year. There is a waiting period. NFIP policies have a 30-day waiting period before coverage begins. So plan ahead. Get it early in the closing process, not when you see a hurricane's coming in a week. Should you get flood insurance, even if not required? Well, take a look at your topography. Consider flood insurance if you're not in a high-risk zone, but you're near one maybe. Flooding can happen anywhere. 20 to 25% of flood claims come from moderate to low-risk areas. Climate change is increasing flood frequency. You can get it for peace of mind. Cost is low risk, and not low-risk zones, typically $400 to $500 a year. Earthquake insurance. Let me talk about that real quick. It's a separate policy that covers damage from earthquakes. Standard homeowners policy doesn't cover earthquake damage. Here in Texas, we're starting to experience earthquakes, even in Oklahoma. So it's getting everywhere now, even along the Appalachians. So anyone living in an earthquake-prone area should get it. So California, the Pacific Northwest, like Oregon, Washington, Alaska, parts of Mississippi, Tennessee, South Carolina. They're on the New Madrid fault line. Even if not in a high-risk area, earthquakes can occur anywhere. I've been through a couple of them. They're pretty interesting. So what it covers. It covers structural damage to homes damaged during the earthquakes and your belongings. It allows for additional living expenses if your home is uninhabitable. What it doesn't cover damage from fire following an earthquake. Your homeowner's insurance policy will cover that. It doesn't cover damage from floods or tsunamis following an earthquake. So where to get it, okay? In California, Earthquake Authority is a state-run program in California. There's private insurance companies in other states. The cost, it varies widely based on location and home type. If you're living right on the San Andreas Fault, it's probably going to be more than if you're not, right? California, the average is between $800 and $5,000 a year, and higher. It's higher in areas near fault lines and higher for older homes. Deductibles are typically 10 to 20%. To give you an example, a $400,000 home at a 15% deductible, that's $60,000 out of pocket before the insurance pays. So is it worth it? Well, It depends on your risk tolerance and your location. High deductibles mean you pay the most moderate damage, right? Then you got catastrophic damage. Is that covered? Umbrella insurances. That's another good thing. Let me talk about umbrella insurances. It gives you extra liability coverage beyond your homeowners and auto insurance. I really recommend that, especially if you have teenage drivers. Standard homeowners liability could be $300,000. An umbrella, they go in $1 million, $2 million, $3 million, $4 million, $5 million, and more. So why you might need an umbrella policy? Someone sues you for injury on your property and the damage exceeds your homeowner's liability limits. You cause an accident and damage exceeds your auto insurance liability. You're sued for defamation, slander, or libel. Your dog turns somebody into a chew toy and causes serious injury. If it protects it, well, what it does is it protects you and your assets from and future earnings from lawsuits. $1 million umbrella policy, you're looking at maybe $1,100 a year. So about another $100 a month. So should you get one? Well, anyone with significant assets, home equity, savings, investments, anyone with a pool, anyone who hosts gatherings, high income earners, anyone wanting extra peace of mind should look at that. The last thing I want to talk about, home warranty. What is a home warranty? Well, it is a service contract that covers repair or replacement of home systems and appliances. Typical coverage, like it covers HVAC, water heater, appliances, plumbing. They have different packages that include different things. You can get them down to like washers and dryers and kitchen appliances, things like that. Not the same as homeowners insurance. Homeowners insurance covers the home. Home warranties are more like maintenance covered policies. They can cost anywhere from $450 to $800 a year, depending on it. The service costs can range from $75 to $150 per visit. So who pays for that? Well, it's negotiable. Sometimes the seller provides it as a concession. Sometimes the buyer purchases it. Sometimes the seller will give them up to $500 and the buyer has to pick up the difference. Is it worth it? There's pros. They protect against unexpected repair costs and they're convenient to one call for service, theoretically. They're good for older homes with aging systems. Let's talk about some cons. Coverage limits and exclusions. A lot of the home warranty companies will try their best to find a way to exclude a repair. Service providers may not be top quality. I've known from experience that it can be difficult coordinating repairs. As you can see, there are a lot of things that go on in the background of buying a home that many uninformed buyers do not even think of. Watching this video ensures that when you purchase a house, it's going to be smoother because you now know what you did not know before, right? So we don't know what we don't know, but now you know what you do know. So I know we discussed a lot of different things. I don't expect you to remember everything. That's why it's imperative to build a great team around you who will take care of everything. I just want to close with this before I close with a story about homeowners insurance. Hey, if you found this video helpful, please hit that subscribe button. That way you can get notified for the other ones that are coming out and you can find the ones that I've already done. If you have questions, put them in the comments and I will do my best to answer them. Now, I spent 14 years as a firefighter. I've been to several structure fires. One year, right before Christmas, we had a house fire. We show up fully involved. We work on extinguishing the fire. They were trying to save money because they had limited income. So in order to save money, they bought this like outdoor heater kind of thing that you cut a hole into your wall and then the heat will come in there and heat your house that way. Well, it caught fire, or it heated up enough to where it caught fire and the house got fully involved. They lost their dog, but all the humans made it out okay. About a month before the fire, they needed to save some money, and their homeowner's policy, the house was paid off. The homeowner's insurance came due. They didn't have the money to cover that. Fast forward a couple weeks, house is destroyed down to the ground. They've lost everything. Their house, their contents, because they didn't have the funds to cover the mortgage insurance or the homeowner's insurance. I saw that firsthand, and so that's why I'm a stickler on it, letting you know about insurance. Most people would just go over it. It is important to make sure that you are adequately insured. Things are going up. Insurance is going up. My umbrella policy just doubled. So I had to make some adjustments for it. It happens to everybody. But just try to make sure that you are protecting your biggest assets the best that you can. Because these people, they lost everything that night. And just like a week or two before Christmas. So just take insurance seriously. You get it with the hope of not needing it. But if you need it, you're going to be happy that you have it. And I don't want to preach or anything like that. I just want to share some relatable story to you, so you can understand the importance of insurance. Because until I got older, and I started getting into the fire service, I didn't really understand insurance and the importance of it. But being a firefighter every day, I was seeing the importance of it. So, but I will leave you with that. Our next video is going to be coming out. Some more great information about buying a home. So I look forward to seeing you in the next video.